Hello, everybody, and welcome to the fDi podcast, the podcast brought to you by fDi magazine. China's go-out policy touched new heights in 2016 when the volume of M&A and greenfield investment by Chinese companies soared to unprecedented levels. However, quickly growing capital outflows took a toll on the yuan and the country's foreign reserves, eventually prompting authorities in Beijing to reinstate a number of restrictions aimed at limiting the flows of hot money out of China. I'm Jacopo Dettoni, Deputy Editor of fDi Magazine and your host for this second episode of the fDi podcast. I'm here today in our studio in London with two very knowledgeable guests that will give us more insights on these restrictions and how they are affecting and will affect Chinese overseas investment in the months to come.
I'm Helena Huang, China economist from ICBC Standard Bank.
I'm Henry Tillman, Chairman of Grisons.
Thank you, guys. It's great to have you here with us today. And let me start with you, Helena. Chinese booming overseas investment hit the headlines throughout 2016. Mega acquisitions like the proposed takeover of Swiss agribusiness powerhouse Syngenta by ChemChina stole the limelight, but the phenomenon went much farther than that. Let me just point out a couple of figures. Non-financial outbound investment reached $146 billion in the first 10 months of 2016 alone, higher than a previous record of $121 billion recorded in full 2015, and these are figures from the country's Ministry of Commerce. In the US, alone, Chinese investment into US-based companies increased threefold in 2016, whereas in Europe, it reached $85.6 billion, which amounted to the level achieved in the 4 previous years combined. The Chinese government, is now trying to rein in to mitigate these capital outflows. So, Helena, what are these restrictions all about, and how do they fit the country's overall go-out policy framework?
Okay, I think most of these media reports came out in last November, and I think back in last November, we should note that the yuan was actually suffering quite renewed and depreciation pressures due to the strong dollar rally ahead of the US election result. And with such a background in mind, and also coupled with the pressure to ensure FX reserve stock stay above the 3 trillion mark, it was actually quite understandable why Beijing wanted to clamp down the illicit capital outflows by tightening up the regulatory restrictions around its capital account. I think the most widely reported restrictive policy measure was Beijing's intention to really exercise tighter regulatory scrutiny on corporate M&A abroad. As mentioned in various media reports, as you can see in Wall Street journals, etc., Beijing was preparing to suspend approval for overseas M&A deals valued at or beyond US dollar 10 billion, and also it probably would turn off the green lights for corporates, including the SOEs, which intend to invest in overseas properties and non-core businesses valued at above 1 billion US dollar. But having said that, at that time, actually, there was no announcement of such restrictions in any of the official document back in November. So that's what's to note. I think only until when we started to run into the Chinese New Year in mid or late January this year, then we see the State Council document being published actually on the 18th of January, when the State Council, together with the State-Owned Assets Supervision and Administrative Commissions, which is also called SASAC, jointly released the revised regulations on onshore and offshore investment by state-owned enterprises, which basically promising to release a negative list detailing the off-limit investment projects that the SOEs won't be allowed to invest in. So I think that document hasn't gained much media exposure as yet, and that was actually quite a very important document for us to pay attention to. And SASAC actually in that document, although it didn't really specify which industries or sectors will be included on the negative list, but in principle, I think the new rules should really ban SOEs overseas investment investment in the sectors that is irrelevant to the firm's main business, similar to what has been really reported in last November and December, when the four monetary authorities, namely the PBOC and the three regulatory commissions in onshore China, warned of irrational outbound investment trends in sectors including properties, hotels, cinemas, entertainment, sports club, etc. And the new guidelines should also urge centralized administration, sort of centrally regulated SOEs to step up their risk control measures of overseas investment. So I think before what we can know the do's and don'ts in the forthcoming negative list, the new set of guidelines is very likely to impact central SOEs' enthusiasm to invest abroad due to regulatory uncertainties as such. There are currently over 100 SOEs under direct supervision of SASAC, so it is not clear as yet if the local SOEs will be affected by this document.
Harry, waiting for this negative list and these new rules to be fully implemented and fully disclosed, this has been a pretty impressive regulatory turnaround by Chinese authorities. You guys at Grisons have been tracking closely Chinese outbound investment for many years. Is there any early evidence that these restrictions are already affecting the flow of Chinese outbound investment?
As you mentioned, we track every transaction, M&A outbound, upon announcement, rather than the Chinese through Ministry of Finance and standard M&A technology. And it shows, very consistent with what Helena was suggesting, the aggregate amounts by month peaked at 32 billion announcement in October of 16, fell to 16 billion in November of 16, declined further to 9 billion in December of 16, up slightly. We could talk about later the strategic importance of that number, of 12 billion in January 17, and through this month, through yesterday, is only 6 billion.
So it's pretty clear there has been a slowdown in the announced
and on a consistent basis. If you look, except for a small blip in January on some strategic investments, the trend is clearly down all the way from October monthly through February.
So what's your perception on these restrictions?
I think I would agree with all the things Helena said, basically. But I would also think that it got a little frenetic earlier last year, as you were mentioning in your opening remarks, Jacopo. So I think it's, as China has always done, it's several steps forward to take a little step back, to take a breather to see how these are working out. So I think it's a very wise policy decision, which we support, not from someone in the advisory business, like your institution and our institution. It's not necessarily great for at the company level, but I think it's the right thing for China to have done.
Obviously, Helena, you were mentioning the strategic importance of this investment when it comes now moving forward, when it comes to SOEs investing overseas and investing in businesses that maybe they haven't got much in common with their core business. But what does it mean? How do we define what is strategic and what is not strategic? Should we expect Chinese authorities to draw a line for what is strategic for the company or for what is strategic for the country as a whole?
I think there are much to be expected from the forthcoming negative list, and at this stage it's definitely too early and premature for us to make any speculation around what's going to be included in the negative list. But as I mentioned before, so anything potentially related with property, real estate investment in football club, for example, and entertainment industry probably will suffer a little bit from this negative list in terms of the forthcoming or near-term outflows of ODIs or M&A activities. So I think, but in principle, or in essence, the main concern that Beijing wants to address through these restrictions, I think as far as the official rhetoric goes, the basic principle is really to ensure the balance between the capital inflows and outflows can be achieved, and at the same time that any risks from onshore and offshore can be contained within the macroprudential policy framework that the BBOC is currently trying to build up.
Maybe I'd just speak to some of the numbers that are consistent with this. So the flows in December of size were infrastructure flows, infrastructure investments, particularly in markets that are strong along the Belt Road, for example, UK infrastructure with CIC. The largest transaction in December was a coal transaction in Australia, which is clearly strategic and has been strategic for three decades at least, or maybe 4 decades now in Australia. And to date, in February 17, half of the investment outbound has been one oil and gas transaction in the UAE. And the financials and small real estate, I should say, not like before, have been around fintech or financials which have some future relative to Ant Financial. Ant Financial's made a couple of major deals. But interestingly, and consistent with the government, 40% of the volume in this year so far has been consumer transactions. So very consistent with growing the consumer base and buying consumer brands in Europe and bringing those back to China to grow the consumer back in China, business back in China.
So, guys, looking forward, what are your expectations for the months to come? Do you expect these restrictions to remain in place, or as they gain traction, as they lift some pressure off the one's shoulders, they can be somehow rolled back?
I think it is clear that Beijing will still support the legitimate overseas investment, and particularly be very supportive for the Belt and Road Initiative going forward. What will be affected, as we've already discussed, are those called irrational investment, if you like, or M&A activities that deems as with no business relevance, such as the real estate, entertainment, etc. The regulators definitely will pay a closer attention around investment as such. And also going forward, I think it is likely that Beijing is going to potentially exercise more forceful policing and regulatory scrutiny if there is renewed pressure on the currency itself. But again, like ensuring social and economic stability will definitely be the priority and the single most important policy priority ahead of the 19th Congress meeting due in autumn later this year. But long-term wise, we don't think the current restrictions around the capital control will stay there forever. Beijing should still be very much committed to a gradual opening up or liberalization of its capital account as part of its commitment to the global communities upon the yuan's inclusion in the SDR basket. So in other words, I think easing of application procedures for ODI is definitely linked with China's effort to move forward with capital account liberalization. It's just that we have potentially need to be a bit patient to just be a bit patient for us to see that happens gradually.
Harry, regulatory risks are on the rise in China, but also Europe and the US, where authorities are trying to put under higher scrutiny deals by Chinese M&A and greenfield investment by Chinese companies. And now, for example, with in the deal in the takeover of Syngenta by ChemChina, there is still a final green light by a European authority pending. And also in the US is going to be again reviewed by a committee, an antitrust committee within the Congress. So do you think that overall this kind of growing regulatory risk, both on the Chinese and European American side, will eventually have impact the appetite for Chinese companies to invest overseas, but also for the boards within European and American companies to accept to work out deals with Chinese counterparts?
I think, first of all, we live in a very uncertain world and at very certain times in a very uncertain world. So that's an overlying issue, which is not going to go away over the near term, and in fact may heighten as this year evolves with Netherlands, France. So that's Germany, for example.
Maybe Italy.
Maybe less so Germany, but certainly the first two are a question mark. Number one. Number two is, I think there have been, so at the macro level. A second thing at the macro level is I think we're maybe understating the importance of Belt Road here, the BRI initiative, because I think there's a tremendous amount of energy that's and momentum that's developed along the Belt Road, along these countries. And so I think if I'm thinking as a board of directors, if I'm thinking of where I invest, I would invest along Belt Road. It's the future for China for the next few generations. So I'd be looking more along the Belt Road, or I'd be looking more along, as I say before, consumer purchases, smaller consumer purchases, fintech purchases, rather than making big moves which are above the parapet.
So you see deals in these sectors, or deals that they got like that make sense from a business perspective to continue. But on the other hand, you see deals, for example, as it happened last year, chemical companies acquiring cinema production companies in the U.S. Do you see these deals to slow down and to?
Well, I think we've already lost 2 or 3 movie deals already in the last 3 months, right? Even Dolly Wanda just fell over with the Clark Productions last week, so I'm not sure it's officially on the list, but I mean it's clear to me that the government is focused on building Belt Road among the 100+ countries that are now along the Belt Road. And there are large possibilities for growth, whether it's infrastructure, whether it's renewables, whether it's logistics along the Belt Road. So I'd be thinking about that rather than going against swimming against the stream or upstream in other industries or other countries.
Yeah, I agree pretty much. I think we might see some hiccups in terms of Chinese ODIs in this year, 2017. But in general, the emergence of China to become a major global investors in the global markets wouldn't change in the long run. And also, particularly, I think it's also worth to note that China is still in the process of liberalizing its capital account. And usually, when the country liberalizing its capital account, it's quite natural for us to see massive amount of capital inflows and outflows. And what matters, I think, is not the flow itself, but how the government is preparing to address the issues arising. And for the moment, you can see quite actually a healthy response from the Chinese government, from the PBOC. What they are trying to do is try to reduce the potential risks and try to build up a resilient enough macro-prudential policy framework for the future benefits.
All right. Well, thank you guys for being with us today for these very insightful comments. Thanks everybody for listening. You can read all the latest developments on Chinese overseas investment on our website, fdiintelligence.com. You can find all the latest figures on our database, fdimarkets.com. This is all for this second episode of the FDI podcast. Next, my colleagues Courtney Finger and Natasha Turak will report from Cannes, France, where they will attend MIPIM, which is the world's largest international property market, and always an event where there is a lot of foreign investment deals that will be announced and closed there. Stay tuned.